Hey there, everybody. Happy Wednesday. Hump day it is. Geico Camel Day. Markets maybe waiting for the Fed news coming out, the minutes from the last meeting. But the uncertainty out there, and I actually did a piece on this morning, is not really the Fed anymore, though it is obviously major what they're going to do, how they look at inflation, interest rates, all that good stuff. It's about Trump and tariffs. Bottom line, not being political, that's what the market is trading or not trading on right now. This constant flow of news that just quite frankly seems to be getting deeper and deeper, or maybe more, what's the word I'm looking for, trying to be really kind of in the middle here. The rhetoric is just getting elevated. Let's say that. So that is what the market is focusing on right now, guys. Okay. Eco data, not much the rest of the week here. We do have the Fed minutes, like I said. And then next week, we will get some more eco data. So, hello, everybody. Thank you so much for being here. Before I start, I want to get 15 smashes before we start. I know it may sound repetitive to everybody every day because I say it, and it's like I'm just pulling teeth to try and get these smashes and these likes here. Okay, we're at 14. But it really helps us out. It really helps us out. So I am asking. All right, there we go. There we go. So, you know what we have today? Yes, we are going to talk about something called a protective collar. Okay, not the kind you put on your pet when they have surgery. And though I thought that was kind of funny. We've all probably been there. Anybody that's had a pet probably has been there. And it's not the kind that my wife has around me, knowing where I am at all the time. We're talking about free downside protection. Okay? Free downside protection. Now, we all know this is something we talk about all the time, that if we're going to get something, right, if there's a benefit to us for something, there's got to be an offset to that. We've got to be giving something back a little, right? That old adage of you can't get, there's nothing that's free, can't get anything for free, right? Well, that is here as well. But the protective collar is an unbelievable strategy to lock in profits. How many of you, let me ask before I move on here, have ever used a protective collar for one of your positions? Thank you, Karen. That is the cone of shame, Paul. You got it. We've all been there. Our pets have all been there. That is the cone of shame. Okay, Gene, you have not. How about anybody else? Have you ever used a protective collar, or have you ever even thought about it, or do you even know what it is? Because it is so important. Are we frozen here? I hope not. Mike Clark, are we frozen? Sure hope not. I don't think we are. Hello. Test. Can everybody hear me? Test. Sure hope not. Okay, looks like we're good on our end. Okay, you may be frozen from the weather wherever you are, but I think our stream is good to go. All right, so what is a protective collar? Okay, it is definitely a defensive strategy. Okay, what do I mean by that? It's a strategy that will limit further gains, but also eliminate or limit your potential losses. Okay. It protects you against losses from a big decline in a stock price. Okay, you can do it going into an earnings report. Maybe you have, I don't know, maybe you bought Nvidia on the dip last week. And we'll go through some live examples. Maybe you bought Nvidia at the dip sub 120, right? And you want to protect that position. Okay, or whatever other position. And you can do this in your IRAs. You have to talk to your investment manager about this, but you can do this in your IRAs, your 401ks. Okay. And what you're basically doing is buying a put and selling a call at the same time. Okay. So just imagine that before we go into some graphs or anything like that. You're buying a put. So you've got your bottom, right? You've got your, let's call it support here. You're selling a call. So you've got your limit, your ceiling up here. And the ideal situation to do this in, okay, is when you do this for no out-of-pocket cost, literally zero transaction. I'm going to show you how to do that. Okay, you don't want to pay anything more. It's rare that you would get a credit for it. Can happen. Okay, but ideally you don't want to pay it for this position. Both options do need to have the same expiration date. Okay, so let's go a little further here. Okay, so what you're doing, let's say you own, and I'm just going to stick with NVIDIA, and then when we go to the charts, we can look at whatever stock you want to look at. Okay, let's say you own 100 shares of NVIDIA. Actually, let's make it a little more than that. Let's say you own 500 shares of NVIDIA. Okay, you would buy 5 puts. Okay, somewhere below where it's trading. Now, NVIDIA, I think right now is right around 140. Depending on what your threshold is, okay, maybe you buy the 135 put. Okay, you can buy the 138 put. You can buy the 139 put. You can buy the 120 put. Whatever you want. Yes, that's going to cost you money. But at the same time, you sell the same number, and you'll notice that I have in here the same number of covered calls, okay, at a strike above. Typically, they're going to be the same distance apart. If you go $3 below, you go $3 above. 4 and 4, 10 and 10, whatever it is. Now, you'll notice that I use the term covered calls, okay, because they're covered because you already own the stock. Okay, does that make sense? Okay, so you're buying a put, selling a call. You're attacking your stock from both sides. You're locking in profits to a drop if the stock drops. You're also, though, remember, if you're getting a benefit on something, we got to be given something. That give is the fact that we're selling calls above here. So you're limiting potential further gains. Okay. Now, it's not a riskless strategy. Okay. And you're probably thinking, well, then why the heck are we going through this right now? Why are you telling us that this is like such an amazing type of strategy? It's not riskless because it depends what strikes you use. Okay. But it is there to help cushion the blow of a steep price decline, protect potential losses below where the stock is trading. Okay, so a benefit of this protective collar, and we're going to talk about zero cost protective collars, okay, is that there's limited money you're putting forward. In fact, we want to do this as zero. Some people will do it and maybe pay a tiny bit of a debit just to get that protection. And that is because the call that we are selling covers the cost of the put that we're buying. Okay? So we look to do that for zero. Now, again, the risk you have is limiting some of that upside because let's say in the case of NVIDIA, trading 140, and let's say you use the 135 put, 145 call. Well, if the stock screams higher, that's great for your long stock position until you hit the short call, right? So you could get your stock called away from you, but at the same time, it is limiting that downside risk. Okay, does everybody understand that? Limiting downside, limiting upside potential. Okay, and again, we do this hopefully at zero cost. Michael Clark, how many smashes do we have? And Harris, for no particular reason other than I just saw your name pop up on a yes. Give me a stock you'd like to look at to put this type of position on, Harris. We're at 31. Okay, that's good for now. I'm going to move on. Give me a stock, Harris, you'd like us to look at. Okay. And before we do that, here is our word of the day. All right, Harris, I don't know if you heard me or not. HST. Okay. We will look at HST. Let's do it. Okay. Now, sure. I mean, it's $17 stock percentage wise, whether you're $1 away from here, which is about 5% or 8%, or whether we use a $500 stock. Let's use a little bit higher priced stock here. Okay, let's use a little bit higher price stock here. And you know what? Let's stick with NVIDIA. Okay, let's stick with NVIDIA. So here we are. We're trading 140-ish. Okay. All right, you know what? That's a better one, Chris, because they have earnings coming up. So someone that might be long Alibaba stock, they have earnings tomorrow morning. You want to lock in profits, okay? Let's set something up here. Okay? Let's say, okay, and again, every situation is going to be a little bit different here. Let's say you bought Alibaba stock just, last week even at 110. Okay, and I'm sorry, I keep flipping this darn cord behind me. Maybe now it'll stick. There we go. Okay, let's say you bought Alibaba at 110. Okay, and it's up $16. So you're up about 15% in that right now. Great trade. Let's say you are willing, to give a little back, but you want to be stopped out, meaning you don't want the stock to go below 120. Okay, you're willing to sell it at 120. Okay, so remember, one of the keys to the collar trade is both options, the call and the put, have to be the same expiration. Okay, now you can choose your expiration. You can choose the length of time you want, whether you are nervous about an imminent earnings report like Alibaba has tomorrow morning, or whether you want to let it go a little bit. So let's go out to March. Okay, let's give this thing a month, and this will go through earnings. Okay, and let me blow this up here. Okay. Stock is 126. And remember, let's say 120 is your point. 120 is your point where enough's enough. I'm locking in my profits there. Well, what does that 120 put cost you? If you were just to buy that put outright, you're spending $4.25. So what you've really done is you have increased your purchase of the stock that you bought at 110 up to 114.25. Okay, is that clear? Okay, good. Now, this is actually a really interesting one that we're looking at, because now that I look at the options here, and this is a great thing if you own stock and you're trying to protect. This is a great situation because there is a massive skew to the call side in Alibaba right now. What does that mean? That means the upside calls are trading more expensively than the downside puts. So if you're looking to hedge with a collar your long stock position, you're going to get a big benefit in a situation like this. What do I mean? Well, we went $6 to the downside, okay, to stop ourselves out, where we had to pay $4.25. Now, if March expiration here, there are no strikes $6 higher, which would be 132. But if we went to 135, we could actually collect more money selling that call than what we are paying on the put. Not only that, but we're getting more room. We're getting benefit of more room to the upside. So we have $9 of room on the upside before we could potentially get called away on our long stock, and only $6 to potentially give up to the downside. And we're getting a little credit in this instance. So this isn't a zero protective collar. This is actually a credit protective collar. Okay, does everybody see that? Now, again, the keys to this, if you want to have complete hedge, complete protection on your position, if you owned 500 shares, you would buy 5 of these puts and you would sell 5 of those calls. Okay, because if you think about it, if the stock really drops, okay, you're protected at 120 on 500 shares of stock. Owning 5 puts lets you sell 500 shares of stock. If the stock flies on the upside, you could get called away on 500 shares of stock. So it isn't always, unless you want to only hedge, let's say half of your position, but it is always a 1-to-1 to 1. 100 shares of stock to 1 put, 1 call, etc. Okay, let's look at another example here. Okay, and you know what, Harris? We're going to do your HST. Okay, let's look at HST. They have earnings after the close today. Okay, stock is trading basically 17. Okay, so here, there's not a lot of option premium whatsoever. I'm not sure, what the company does and why there's like no expected move built in, but you could protect yourself, Harris, buying the 16 strike puts, selling the 18 strike calls. Okay. Now that just being, 1 strike away, you might as well just sell your stock at that point, because now you really have no upside and you're really cutting your downside pretty tight. Let's look at another one here, guys. What's another stock somebody would like to look at? Anyone? Anyone? Okay, CELH. That's going to be kind of the same thing, Dave. I know you mentioned it before. It's a really, $20 stock, $26 stock. They have earnings tomorrow. Let's look at it. Okay, we could go out. Let's go out to March. Okay, let's see if we can find an X here. Let's go to March 14th, since there are $26, $26 strike options, and the stock is 26. Okay, so you want to protect yourself. Let's say you're willing, I don't know, 10%, right? 10% to the downside. So you might want to buy the 23 put that costs you, just over $1.10 or so. Well, here's another one. Here's another one where you're getting the benefit because there is a big call skew. The implied volatility on the call side is much higher. So if we went $3, so equidistance on the upside, you could sell the 29 call for like $1.60. You could do that for a 50-cent credit. If you wanted to do for zero and just get more room to let your long stock go on the upside, okay, where does that same $8, $10 come in? That comes in right here on the 31 strike. Dave and everybody else, you can do any time frame you want. Okay, because typically in a collar, theta has no bearing whatsoever, because there's going to be the same typically extrinsic value on the call and the put. Volatility, a change in volatility has no bearing, typically has no bearing, because what happens on the call side happens on the put side. So you can do it as short as a day or two if you're looking to just protect based on an earnings trade, let's say. Go out further. And let's say you did this in CELH here. Okay, let's go back here. Let's say you did the 23 put and the 31 call. Okay, you can see here, you can do that right at zero. What would be the best outcome if you own CELH stock? With this position, what would be the absolute best outcome? Come on, bonus points. No movement would not be the best. Yeah, box guy. This is no different. This is no different than any other position we always talk about where we want the stock to move to the short strike. In this case, what happens if we move to our short strike? Our option position remains zero. We haven't lost, but we've gained $5 on our long stock. Okay. If it's anywhere in the middle at expiration from 2301 to 3099, your position is going to remain the same because both options are worthless. The thing you don't want, the worst case scenario, just like the best would be to move to just at the short strike or just below, the worst case here would be to move to 23 or 2301, because now you've lost $3 on your stock and your position is worthless, which you didn't pay anything for it in the first place. Awesome, Paul. Glad you got the t-shirt. So this is really, I would say, more of a strategy to use on a 401k or an IRA position, to lock in maybe some gains that you've had along the way, where you don't want to tell your investment advisor, your broker, to just sell the stock. This is typically used more for that than it is for an option position, but you certainly can use it for an option position. Okay. All right, guys. There is our smash of the day here. How many do we have? How many smashes do we have, Mike? Does anybody have any questions on the collar? And again, you can adjust the strikes based on your tolerance. If you want to pay a little bit to have a little bit more protection, meaning that the put is a little closer to where the stock is, sure, you can do that. Optimally, we'd like to do this for even or even a credit. Okay. Thank you, Box Guy. We do need some more likes here. Anybody want to see another example? Just a real live in the market now example? Because we're going to be closing out the wheel here in about a minute. David, thank you very much. Appreciate that. I'm hoping that you smashed. Okay, Thomas, let's go back here. Let's say CELH went to 20 at expiration. Okay, what would the outcome be? Well, you absolutely would have lost $6 on the stock position, right? But you gained $3 on the put position. So your net would be a $3 loss, which is why you chose the 23 strike put, saying ahead of time, all right, if this stock goes down, I'm willing to get out of it at 23, or you could do it at 24, 22, whatever it is. Does that make sense to you? We'll look at one more, Frank. We'll look at Marvell in a moment here. Just want to make sure that this made sense to Thomas. No, you would not be holding your stock, Thomas, because you would exercise your put. You could, if you want, like Gene just said, if you still wanted to hold your stock position, you could just sell out the put for a gain on the put. But by exercising your put, that would take you out of your stock position. Okay. All right, Frank, I said we would look at Marvell. Okay, Marvell is trading $111. Okay, Frank, is there a certain time frame you want to look at? They have earnings in 2 weeks. Maybe you're looking to put this position on as protection on earnings. Okay, earnings are March 5th. So let's look at March 7th. Okay, stock is trading roughly 111. I don't know what, potentially your cost basis is, 190, 105. But let's say you wanted to protect your gains in your stock and you wanted to keep it real tight. Okay. You weren't worried so much about more upside, but you really wanted to protect those gains. So let's look at something like on the 108, saying, I only want to give back potentially $3. Okay. Your put, the 108 strike, is going to cost you $5.50. Where is $5.50 on your call? 116. Okay, so you could do a zero cost protective collar here. Not going to cost you anything. You're not taking anything in, but you're not paying anything. And this position would stop you out at 108 on the downside. So you'd have roughly $3 loss on the downside. But at the same time, if the stock went up, you're good all the way till 116. So you could profit more on your stock before it got called away. Does that make sense? And again, You can use any expiration you want. Any expiration you want. If you just, let's say you have some stock stuffed away in your IRA and you don't even want to think about it, and you just want to know that 6 months from now, a year from now, whatever it might be, use that expiration. Does this make sense to everyone? And also keep in mind, everyone, just from a public service announcement, education standpoint here, if you ever want to go back and review one of our market minds, one of our education sessions that we have here, just go to the YouTube page. They're all there. Okay, they are all there. Absolutely, it works on ETFs, Thomas. 100%. SPY, Qs, whatever. 100%. Okay, guys. Wheel time. Wheel time. Wheel time. Are we ready? Let's give it a whirl here. Is it going to be Marilyn, Mark, McCarty, Mike, Nancy? Who's it going to be? Come down to Mike and Nancy. Nancy. Nancy, didn't you just win end of last week? Nancy, are you in the house? Uh-oh, did Nancy... Oh, she's here. I thought maybe she just quietly scooted out the back door. All right, Nancy, congrats. You know what to do. Shoot us an email. Okay, I just remember the name. Very nicely done. That means there's new swag coming your way. Email me your info, prosperswag@prospertrading.com. All right, everybody. Appreciate all of you tuning in. This was a really, really good one here. Something that, we don't talk about a lot, but really an important strategy for you to know, whether it's a trading position or, longer term investment. Okay. Special public service announcement. We are having a Prosper Coaches Retreat starting tomorrow. There definitely will not be a Market Minds tomorrow. There may be one on Friday, trying to figure out timing of it. There definitely will not be one tomorrow. All right. Thank you, everybody. Always appreciate all of you. Fed Minutes coming up soon here in half an hour. Talk to you later, everybody. Bye-bye.